Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 28th. Well, Singapore joins the easing parade. Overnight, the Monetary Authority of Singapore became the latest central bank to ease policy when it unexpectedly cut its inflation forecast for this year and said that it would seek a slower appreciation of the Singapore dollar as a result. Singapore doesn't control interest rates, but rather uses FX appreciation as its monetary policy tool. It attributed the change in view to the decline in global oil prices. Now, the MAS only has 2 scheduled policy announcements a year, so this in-between meeting announcement was really quite unusual. It was the first since 9/11. Singapore joins India, Canada, Denmark, and the ECB in easing policy. Their action immediately raises the obvious question: what will the FOMC and the Reserve Bank of New Zealand do tonight? I'll get to that in a minute. Australia's fourth quarter CPI was up less than expected, but the trimmed mean CPI accelerated on a quarter-on-quarter basis. The market's focused on that measure, and expectations of a rate cut at next week's RBA meeting faded sharply. In this respect, Australia is somewhat of an anomaly to the global trend. I don't expect this to last, however, as I can't see how a country whose major exports are coming under such pressure can buck the global deflationary trend indefinitely. For today, the highlight during the European day will be Norway's AKU unemployment rate for November. It's expected to remain unchanged, but the official unemployment rate for the same month declined, so the possibility for a positive surprise could strengthen the krone somewhat. Later in the day, of course, comes the FOMC meeting. Some of the points to look for are: will they remain patient, as they said in December? How is their assessment of the U.S. economy changed? In particular, how will they assess employment and inflation, their 2 targets? And finally, does the global outlook feature in their thinking? I explained yesterday why I don't expect any change in their view and look only for minor changes in the statement. In short, employment is moving closer to the Fed's target, but inflation remains below where they want it to be. This combination allows them to remain patient and argues for no significant change in the statement. The message is likely to remain that so long as the labor market continues to improve and they continue to expect inflation to return to 2% in the medium term, they can begin to normalize rates around the middle of this year. That's more or less what the market's forecasting, as the Fed funds futures contracts are discounting a 25 basis point Fed fund rate from August. Now, in my view, a largely unchanged statement would probably be dollar supportive. Overnight, the Reserve Bank of New Zealand meets as well. At its December meeting, the RBNZ stated that the next move in rates was likely to be up. However, following the sharp fall in inflation in the fourth quarter to below the lower boundary of the bank's target range, 1% to 3%, I think there's a strong possibility that they change their stance and return to neutral again. Such a move would probably put the New Zealand dollar under selling pressure. The country's trade balance for December is also coming out. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.